This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now, together with this basic and additional expenses, there may be some other expenses listed in the question, such as light or heat that have been paid by the employer. If that's the case, then you need to add those in exactly as they are. But when the accommodation is job related, it's slightly different. The taxable limit is 10% of other employment income. Okay, now this other employment income, I'm going to quote this. 10%, the total accommodation benefit taxed on an employee is 10% of net earnings. That's the maximum. I'm quoting from my textbook here. I want to make sure that I've got this correctly because I've had a couple of questions about it in the past, so I just wanted to add it in here. So this net earnings is employment income including all benefits, benefits in kind, other than these this expense is connected. So that's what that entails. Okay. Now, second benefit that we're going to look at is use of assets. It may be that during the job that you are doing, that you use assets that belong to the company. And this is the rule as to what is and what isn't taxable. It's normally 20% of the market value when it was first provided. So that's a simple maths situation. Now, this, because that is simple, it's normally linked with gifts of assets. So normally what would happen was perhaps you would have use of an expensive laptop and you'll use it for 2 years. You'll have benefit in kind on it for 2 years. And after 2 years, they will gift it to you. Now, that needs to be taxed. So if an employee is gifted a new asset, then you pay the cost of that asset because that's what it is. That's what you've been given. That's the cash value and that's your benefit. However, if you've used it previously, as in the case of a laptop, it's the higher of the market value of the asset when it was given to you, or the market value of the asset when it was first available, less any benefits that you've paid on it during that time. Okay, it does not apply to a car and a van. Okay, does not apply to a car and a van. So let's have a look at example 3 of how that works. So Gerald's employer bought a TV for his use on the 1st of June and it cost £900. On the 6th of April 2023, Gerald was given the TV by his employer when its market value was £250. Calculate the benefit assessable on Gerald in respect of the gift on the basis of A, if he paid nothing for the TV, or B, if he paid £250. So you could see this as potentially multiple choice question, can't you? Rather than a big question. You normally find the big questions includes cars and accommodation because there's a lot of numbers to work through. But for this one, it's much simpler. Okay, so let's have a look at how that would work in an answer. I'm going to use this little bit of space here. So let's have a look at the A part. So the market value when first available, that's the rule, was £900, less the benefits assessed, So in 20, 22, 23, we have £900 times 20% times 10 months. Always check the dates. This is benefits in kind. This area is one of the examiner's favourite for putting funny dates in, so just be aware of that. Okay. So the taxable benefit would be 750, because this is higher than the market value when it was given to him. Because when it was given to him, the market value was only £250. So that's what would be taxable. With the B part, the sale, well, we have the benefit in kind already. We've worked that out. That was £750. Okay. Less the price paid. Which is £500. So you can see how that works. So let's move on to the major one that comes up in almost every exam, and that's company cars. The assessable benefit on a car is the list price times the CO2 emissions. Okay. Now, this is not the price that they paid, because if you are an employer and you've bought a fleet of cars, then you'll probably get a really good discount for it. So it's the list price plus any optional extras, alloy wheels, all those sort of things, paint jobs. Now, that list price can be reduced by a capital contribution. Be careful when you read the question that it's not a contribution towards the use of the car, and especially if it's for the fuel of the car, which isn't allowed. It has to be a capital contribution. So say, for example, the model they are giving you is worth 15,000, and you decide that you actually want the next one up, which is 18,000, and the employer isn't prepared to pay that extra 3. You could, should you want to. Now, you're never going to get it back, so should you want to, you can pay that extra 3. But the maximum is 5. Now, the CO2 emissions are given to you in the exam. Okay, and it looks like that. So the base level is 55 grams, and then that's 15%. Everything over that is 16%. Hybrid cars, depends. We've got all this details here of the various different percentages. Okay, so the car benefit is calculated list price less CO2 emissions. So that's the list price plus optional extras less any capital contributions, and then you've got the CO2 emissions. These are in the rates of your exam, and any test that you do not guess. Okay. For petrol and diesels with emissions over 55 grams, the base percentage is calculated as 16 plus 1% for every 5 grams over 55. And I'll show you how that works in a moment with an example. And then to calculate the additional percentage, you round the emissions down to the nearest 5 grams per kilometre, deduct the 55 and then divide by 5. That's essentially what we're going to do. There's a 4% supplement for diesel cars that don't meet the RDE2 standards, and the maximum is 37%. Now that's not 37% plus 4% for the diesels, that's 37%. Now that benefit can be reduced proportionally if it's unavailable for at least 30 days, or if they make a contribution to the employer for the use. Different terminology there, for the use, not the capital contribution. Okay, if you've got 2 cars, you pay 2 benefits. Now, a pool car is where the employer has several cars that are available. So, like I said before, if you go out on audit, you don't have a car, you can get in a pool car, you drive it to the employer, you drive it back again. You don't take it home. This set of rules is to tax people who have cars available for private use. If you're just using a pool car to and from doing things, going to the post office, going to the bank, going to wherever, that's not taxable because it's kept at the place of work. So we're going to have a look now at example number 4.